Capital One Financial Corp is trading at $233.41 USD as we speak, reflecting a sharp decline of 15.74 points, or 6.32% during today's session on January 12, 2026. This sudden drop has caught many traders by surprise, especially those who were looking at the stock as a prime beneficiary of the recently completed Discover merger. While the broader market indices are showing some nerves today, the specific pain being felt by Capital One shareholders is tied to a much more targeted event. You might think this is just another typical bank fluctuation, or perhaps a reaction to upcoming earnings, but the reality is far more complex and involves a massive shift in the regulatory environment that could fundamentally alter how these companies generate profit. The common expectation among retail investors lately has been that Capital One would simply steamroll through 2026 by leveraging the Discover payment network to cut costs and steal market share from the big players like Visa or MasterCard. However, the immediate reality we are seeing today is a direct response to a massive policy proposal from the White House. President Trump has called for a one-year cap on credit card interest rates at 10%. When you consider that many Capital One card products currently carry annual percentage rates between 20 and 30% to account for credit risk, a 10% cap isn't just a trim, it is a total restructuring of the business model. This creates a curiosity loop for any smart observer. If the government actually forces a 10% cap, does Capital One stop lending to everyone except the most elite borrowers? Or do they find a way to make up that lost revenue through the Discover network fees? Most people using an individual brokerage or checking their portfolios on the Fidelity mobile app today are seeing red across the financial sector, but Capital One is taking it particularly hard because it is fundamentally a credit card company disguised as a bank. Unlike a more diversified firm you might find on the Interactive Brokers platform, Capital One relies heavily on the interest paid by consumers who carry a balance. If you look at the recent trading volume, it has spiked significantly as institutional players and retail traders on the Robinhood app react to this news. We are seeing millions of shares changing hands as the market tries to price in the probability of this 10% cap actually becoming law. Many analysts are currently debating whether such a move is even possible without a full act of Congress, but the market tends to sell first and ask questions later. This is exactly what we are witnessing with the 6% drop today. The expectation was a smooth integration of Discover and a steady rise in net interest margins. The reality is a political lightning bolt that threatens to slash those margins in half. For those who do their online investing through the SoFi trading platform or use tools like Schwab Intelligent Portfolios, this volatility represents a massive divergence from the stable growth narrative that dominated the end of 2025. Let's look at the numbers. Capital One recently reported a net interest margin of 8.36%. That is incredibly high for a bank, and it was driven by the high interest rates they charge on their massive credit card portfolio. If the interest rate is capped at 10%, that margin would likely collapse. This is why the stock is one of the worst performers in the S&P 500 today. You have to wonder if the people using the Fidelity trading platform or doing self-investing through Robinhood investments are looking at this as a buying opportunity or a warning sign that the golden age of credit card profits is over. Institutional activity suggests that big players aren't completely abandoning the ship just yet. For instance, Sumitomo Mitsui Trust Group recently increased their holdings in Capital One by nearly 8%. They now own over 1.5 million shares. These are sophisticated investors who likely see the long-term value in the Discover acquisition, regardless of temporary political headlines. They understand that Capital One is moving its debit card portfolio from MasterCard to the Discover network, which allows them to capture more of the transaction fees that usually go to the big networks. This is a move toward a closed-loop system, similar to what American Express uses. Despite the current carnage, we have to look at what Capital One actually is. It is a diversified financial services holding company that has spent the last 2 decades positioning itself as a tech-forward lender. They use massive amounts of data to price risk, which allows them to lend to people that other banks might ignore. This is why you see so many people using the Capital One app alongside their Fidelity IRAs or their SoFi active investing accounts. They have a massive presence in both the consumer and commercial space, with hundreds of billions of dollars in deposits and even more in total assets. The Discover merger, which was finalized in mid-2025, was supposed to be the catalyst that took Capital One to the next level. By owning the payment network, Capital One no longer has to pay as many fees to outside parties. They are currently reissuing millions of debit cards with the Discover logo. This transition is expected to be finished later this year. The idea is that the more people use these cards for daily spending, the more fee income Capital One collects, which provides a nice cushion even if interest rates are pressured. But today's news about the 10% interest cap overshadows all of that. It's the tension between the long-term benefit of owning a network and the short-term disaster of a government-mandated rate cut. I want to pause here and ask for your take on this. Comment below how many shares of Capital One stock you currently hold, or if you are planning to exit your position because of this new interest rate proposal. It's a heated topic, and I want to see where this community stands on the political risk versus the fundamental value of the company. Looking closer at the intraday movement, we saw the stock hit a low of $228.70 earlier this morning. That was a drop of over 8% at one point. We have seen a slight recovery since then, but the sentiment remains very bearish. This is the kind of day where people using the Interactive Brokers app are likely setting stop losses, are looking for hedging opportunities through Fidelity ETFs. The trading volume has already exceeded 8 million shares, which is much higher than a typical Monday. This indicates that the conviction behind the selling is strong. There is also the upcoming earnings report to consider. Capital One is scheduled to release its fourth quarter results on January 22nd, which is just 10 days away. Usually, investors would be excited about this, looking for updates on the Discover integration and how the holiday spending season boosted the bottom line. But now, every question on that conference call is going to be about the 10% cap. Management is going to have to explain how they can remain profitable if their primary revenue stream is legislated into the ground. They will likely point to their diverse business model, which includes auto financing and commercial banking, but credit cards are the heart of the machine. If you are someone who likes to invest online or uses an intelligent portfolio, you need to understand the business model deeply. Capital One makes a lot of its profit from what is called the provision for credit losses. They set aside a certain amount of cash to cover loans that might not get paid back. When interest rates are high, they can afford to take on more risk because the high interest from the good borrowers covers the losses from the bad ones. If you cap the interest at 10%, the math stops working for a large portion of their customer base. They would have to tighten their lending standards significantly. This could lead to a situation where fewer people get approved for cards, which then lowers the transaction volume on the Discover network. It's a potential downward spiral that the market is clearly worried about today. Compare this to stocks like Apple stock or Nvidia stock, which are driven by product cycles and technology demand. Capital One stock is driven by the consumer's ability to pay and the government's willingness to let banks charge for that risk. While people might use the Fidelity brokerage or the Robinhood app to trade all of these, the risk profile of a bank like Capital One is vastly different from a tech giant. Even companies like SoFi, who started in student loans and moved into broader banking, are feeling the heat today because they also have a growing credit card business. The reality of the situation is that the Discover network is a powerful asset, but it is not a magic shield. It takes years to build the merchant acceptance levels that Visa and MasterCard have. Capital One is working on this, and they are even adding perks like cash back to their new Discover-branded debit cards to encourage use. If you check the Robinhood Crypto or Robinhood Cash Management sections of your app, you'll see that every financial tool is trying to find ways to keep customers engaged. Capital One is doing the same thing by bringing Discover customers into their ecosystem. The goal is to have one app where a user can manage everything, which reduces the cost of keeping that customer over the long run.
As we look toward the end of the month and that earnings call, the focus will be on the balance sheet. As of the last report, they had nearly $470 billion in deposits. That is a massive amount of liquidity. If they can keep their funding costs low while the market remains volatile, they can survive a lot of pressure. This is why some long-term investors might see this 6% drop as a discount on a high-quality franchise. They believe that the 10% rate cap is just political theater that will never actually pass through Congress. If that belief turns out to be right, the stock could rebound just as quickly as it fell today. However, the expectation of a quick recovery might be premature. We have to consider the macroeconomic pressures. Inflation has been moderating, but if the government starts capping interest rates, it could actually lead to more consumer spending in the short term, which might put upward pressure on prices again. It's a complicated web that makes